All right, greetings and welcome once again, fellow traders. This is Michael Storm, also known as Robinhood, and welcome to the myforextraderoom.com video number 2, I believe, Introduction to the Forex Market. Part 1, today we're going to talk about our terminology. Now, everybody has their own terms, okay? Lawyers go to school for, I think it's, 4 years or 6 years to learn all of their lawyerly language, okay? Doctors go to school to learn an incredible amount of information, but not just the info, but they also have a terminology that they learn while they're there so that they can talk to each other and you in those terms, okay? And make you feel kind of low because you don't understand it, and it kind of helps to justify, their $250 bills when you go see them for 15 minutes to have a little chat, all right? So they got to have fancy words to help, justify all that info. I'm sorry, all that highway robbery. I'm just kidding there, okay? But anyway, we do have terminology in the Forex market. We want to go over that today, okay? So when we say that we are going long, or we're going to long something, like I'm longing pound yen, for instance, or I'm going long pound yen. It just means buying or purchasing of that currency pair. Now, when I buy, let's say, Great British Pound against Australia, I'm buying the pound and I'm shorting the AUD. So if we say I'm shorting something, all right, that just means to sell a currency pair. Like if I said I am now starting to short the Euro Japan, it means I'm selling the Euro short and I'm buying the Japanese yen. Okay, it's that simple. Some people might ask, like, how can we sell something we don't own? And I just want you to remember that currency pairs are linked together. Okay, so if you're selling something like the euro dollar, you're in essence buying the US dollar and selling the euro short. Okay, you can sell short things, you can buy things. It's just a linked trade always. Okay, but every trade that is linked, it does have to eventually come to an end. We choose when to do this. This is called closing the trade or booking the trade, and this close is either in profit or it's in a loss when it's executed. We choose when we get out. I mean, you don't have to get out, I guess. I guess you could stay in a trade forever, but the only trade I would really like to stay in forever would, would probably be US dollar TRY. Somebody please give me a time machine. I would like to short the absolute top and just stay in the trade forever and ever and ever. Okay, that would be great because I can sit back and collect 30 swap payments a month for the rest of my life. That would be pretty cool. All right, so next we'll talk about correlation. Correlation is a description of how two or more currency pairs, they will interact together. For instance, usually when we see the Australia dollar go up, we're going to see the New Zealand dollar go up along with it to some extent, as they often track together most of the time because they are currencies that are linked to commodities, especially like, gold, copper, things like that. They're linked in some way to China, too. So when we see the euro US dollar go down, and for instance the Great British Pound US dollar going down at the same time, or the same rate, the same rate of speed, we will usually see some dollar strength, okay? And that manifests itself in a reversal on the other pairs. You would tend to see the US dollar Canada tracking up and the US dollar Swiss franc tracking up. Now, the reason for that is because if you look at the term USD CAD, USD is first, okay? So that means the US dollar would be rising and Canada would be weakening. And if the US dollar Swissy is going up, you have the US dollar gaining strength, the Swiss franc will weaken, okay? And that's why you would see the Euro USD, the Pound USD, because Euro comes first, Pound comes first. You would see those things go down, and typically you would see the New Zealand dollar and the Australia dollar also tend to drop to some extent. So the correlations are just currency pairs being linked together and traded together in some way. All right. So another great example would be like the euro pound. If you see the euro pound going up very strong, I mean just shooting up, flying up, 15-minute just going crazy, and it just goes up, up and away like a beautiful red balloon, you would be watching all the euro pairs gaining strength. It's just expected, and chances are you would see it. Okay, and all of the pound crosses would be sinking because the euro's heading up and the pound is crashing. Pound is getting weaker and weaker, and that will affect all of the pound pairs pretty much at once. Okay, relative strength will be seen if you're seeing a lot of pound pairs crashing, but one of them really isn't. If it's just kind of staying flat, then that would be a sign of relative strength, which is another word I forgot to put in here. But yes, it's relatively strong. Okay. All right, so everything is connected together in some way in the Forex market. This is completely natural. So what is a pip and how much is it worth? Let's get to that. A pip is called a percentage in point, and pardon me, it is the smallest measurement of movement in a currency pair. All right, let me think where I can even put my my cursor right now, just so that it's not in the way of everything. This pip, which is a percentage in point, okay, it's the smallest measurement of movement in a currency pair. So if the euro is trading at 112.10, that's like a $1.12 and 10 pips. It's 10 pips above 112. And there are 100 pips to get to each cent of movement, to the next whole figure, like 113, 114, okay, 115. These are full cents of movement, and that is called a figure or a handle. And sometimes you can even hear the news guy if there's some really amazing day that happens. The euro dollar has moved 3 full figures or 3 full handles. They'll say that. They'll say the euro's moved 3 big figures today or 3 full handles today. It's a pretty rare day lately, but a long time ago it didn't used to be so rare. But that is the equivalent of a 300 pip move. So how much is this worth? And that varies on whatever your position size is that you are trading. So we'll talk about that value right now. A pip is a fluctuating thing, and it varies from currency pair to currency pair. But on the euro dollar, as an example, a pip can be $10 each for a full standard. It can be $1 for a mini lot. Okay, a mini lot is just 10,000 units of currency. It's a tenth of a standard. Or it can be 10 cents for every pip on a micro lot. So if you take a micro as a scalp on the euro, and the euro moves 7.8 pips, you would get 78 cents on every micro. $7.80 of money you could book for a mini lot, or 78 full dollars on a standard lot. All right. So as we move up in what we trade, and our accounts are going from the $1,000 account balance progress, and we go up to 2,000 or 3,000, etc., we're going to be raising our micros. We won't just trade at 0.01 for every bullet. Every bullet that we ever fire off will be traded at 0.02. So on a 2,000 account, trading at 0.02, all right, that would just double. $1.56 is the equivalent to 7.8 pips. Right, so the euro pound is about 50% more expensive. It's more dangerous to trade. It's 15 cents roughly. I know that's not exact. Okay, that does fluctuate. But roughly it's 15 cents for every micro to trade it, $1.50 for every mini lot, and $15 for every full-size standard of $100,000 of currency. So if you took 0.20 long, which would be 2 minis on the euro pound, and it was an intraday swing, and you nabbed 28 pips of profit, that would be roughly $84 of profits. Because 0.20 traded is approximately $3 a pip, and then you would times that by 28 pips of movement. You don't have to do this, thank God. Your platform, your MT4 platform does this for you. Okay, so you can just look in your account history and see your money and see what you've gotten. Now, some pips are worth like 0.087 cents a micro, okay, but which would be like 87 cents for a mini lot, or $8.70 for a full standard. Things like the pound New Zealand, the pound Australia, they're worth less money, okay? And especially when you get into some of the other currencies like SEK, DKK, MXN especially, they're just worth less, a lot less. Now, some are worth a tad more, like the Euro Japan and the pound yen. They're closer to 12 or 13 in value. Some of these are very cheap. Like I said, the USD MXN pays, I think it's like $3.40 for a full standard. So you see that pips really do fluctuate a lot. But to compensate for this, okay, we basically talk about pips of value, with the value standardized at 10 for simplicity, okay? So you're a future multimillionaire, by the way, and that's no joke. Do the math. Sit down, think about it, do the math. It's awesome. If you don't take my word for it, but you sit down with a pen and paper and work on it for half an hour and see that if you make 100 pips every day of your life, you are indeed a future millionaire. Okay? Actually, a multimillionaire. If you can do this consistently for years on end, that's all you have to do. Trading at 0.01, that would be about $10 a day in profits. 0.02 at 100 pips of value. Okay, we're taking all of your trades on every currency out there and just, you know, averaging them out. That's going to be about $20 a day in profits. 0.03. Oh, I did the wrong thing there. I should say 30. Ah, well, listen, I don't want to edit this out, okay? You know, that right there should say 30. I just don't want to edit it out because my time is precious and it's taken me a lot of time to make these videos, and I got like 38 more to go at least, okay? So you're going to get the hang of this. All right, so trading at 0.10 trade size and ending a day with 185 bucks in profits simply means that you made 185 pips in value for the day. So any day that you can make 100 pips or 185 pips or 265 pips or 377 pips, I am just telling you, you are in glory land. You have no idea what's coming, okay? No clue how good things are going to get as the years go by. The majors, let's talk about those. These are the main currencies that are traded. The euro is a major. It's a very important pair, all right? The Great British Pound is called the Great British Pound or sterling or cable or just pound or pound dollar. There's lots of, you know, different things we can call it. JPY is the Japanese yen. The AUD is the Australia dollar, and we can also call that the Aussie. The Swiss franc we can call the Swissy, and the New Zealand we can call the Kiwi, and the Canadian dollar is also called the loonie for their country's bird, which is, by the way, a very beautiful sound that it makes, especially when you've been rowing a canoe 6.5 hours a day, 5 days straight through lightning and thunder and everything, because you've got to make those 92 miles. And you know, I know I'm getting off topic here, but you know, I once did that. I had to do the whole thing, the Allagash Wilderness in Maine. I had to do the whole thing in 6 or 7 days, 92 miles. It was insane. But you know, in the morning when you're sitting out there listening to that bird, or is it in the evening? You know, I can't remember. Anyway, back on topic. So sorry. It's a cool sound. I'll just tell you, it's a cool sound. All right, majors continued. Now, on a side note, all right, this Canadian dollar is called the loonie, as you can see, because all Canadians are basically crazy. They live in a place that has winter for 9 to 10 months, so obviously they're nuts. No, I'm just kidding. No. It's the bird. All right, so I'm just trying to break it up, give you a little bit of humor here. The U.S. dollar is called the buck or the greenback. Okay, crossing these majors against themselves gives us a staggering number of currency pairs to trade. Okay, if you do this right, you get 7 of these against the dollar and 6 more of them against the yen. And this goes on to give us 27 or 28 pairs, quality pairs that are good. All right. Then we throw in a few of the dollar cross exotics. I put 6 of them myself. You know, I like NOK, TRY, MXN, SEK, DKK, and ZAR. The ZAR is the South African Rand. You know, I just like those pairs. All right, I don't want to trade the HUF or PLN or anything else. Just those. So if we add in a little bit more, like gold and silver, some oil, you don't need to trade them both. You could just trade CL, which is you know, light sweet crude, or you could trade Brent if you want to, but it's more expensive. You could trade the DAX, which is the German stock exchange, or pick another stock index, perhaps the Dow or the NASDAQ. The NASDAQ is a little bit cheaper to trade than the DAX. It doesn't hurt you so bad, and it definitely doesn't move as much in one day as the DAX does. But if you throw in a few of these other pairs, all right, we've got some really good amount of pairs to trade. All right, so it brings you just under 30 anyway. So some of these we call mild exotics, by the way, like the Euro Australia. That's a mild exotic. The Pound Canada, you know, it's a mild exotic. It's not so wild. Then you have some other exotics like the CAD Swiss franc or the Odd New Zealand, and sometimes they move great and sometimes they don't. All right, and then we have the dollar cross exotics like the US dollar TRY. That would be the Turkish lira. So anyway, spreads, lots. Let's talk about spread and lot size. Now, spread is the pip difference between the bid and the offer. The bid is what folks are willing to buy for, and the offer is what they're willing to sell it for. All right, and the difference can be very small, like 0.01 on a super high liquidity time. Hit that button by accident. Sorry about that. All the way up to maybe 2.1 pips on the euro dollar, depending on your liquidity. Depending upon your broker, of course, and depending on the time of day. Now, spreads on other pairs can be higher, sometimes 4 to 10 pips, and you'll usually find things like Pound Canada, Pound New Zealand will, you know, tend to be that way. And the dollar cross exotics can have 50 pips to multi-hundred pip spreads, depending on the time of the day, the broker, the liquidity that's available in the market, or news. Like right before news, you can open up an order box to place an order, and you will see the spread go crazy, plumb crazy. It just gets wild. On Brexit Day, for instance, which happened many weeks back, the spread on the pound crosses was 50 to 80 pips. Just to get involved on a full standard could easily cost you $500 to $800 just to get involved on a full standard on that night. And I remember seeing that and saying, whoa, there is no way I would be trading full standards on that night. No way, Jose. So let's talk about lots. Lots, again, you can have a micro lot, a mini lot, and a standard lot. And that's basically 0.01, 0.10, or 1.0. Now, some brokers, a few of them, will actually allow you to trade in nano lots. I know that Awanda lets you trade in any amount whatsoever. And even my broker, Forex Broker Incorporated, lets me trade minis, micros. I can actually chop a micro into 10 pieces. It's really weird. And I mean, not that you want to, because you're not making any money trading like that, but and then there's, you know, quarters and standards as well. Okay, so you can do a 0.25 lot, that would be a quarter, or a 0.50, we would end up calling that a half of a lot. All right, quarters and halves. Entry, when we say entry, it's the price point where we have entered a trade long or short. It's just where we got involved. It's where we got in. target, or TGT, if we're doing an abbreviation in the chat room, it just means the price point where we're attempting to take our profit on a trade. And a stop, or a protective stop order, is an order to get out of a trade at a loss. Or an ITM, if I ever say ITM, it's known as in the money, in profit. It's a very common term. It's used in stocks. It's used everywhere. Everybody knows that ITM means in the money. All right? And if we happen to be moving our stops as the currency moves in our favor, we might be moving a stop loss up underneath, like let's say we purchased a 15-minute buy and it goes up 5 bars. We take half of the trade off because it pulls back and it gives us a very narrow range bar and we're unsure if it's going to drop right back down to our entry point. We might move our ITM stop up to break even plus 5 extra pips of profit just for our trouble, so that nothing bad happens. And then we have a free ride. Okay, free ride just means your back half it's sitting there and there's nothing that can happen to you other than you get stopped out for a profit. Now, that I do want to pause here for a moment. I know I'm not changing screens, but I just want to say that that's a good thing, because if you see a 15-minute buy and something rocks up 5 bars and then makes a narrow range bar and decides to make a small 15-minute sell, but then that 15-minute sell doesn't work, okay? And it doesn't go down. I mean, the prices don't go down, but it turns around and breaks out and goes higher. It's a very beautiful thing. Now you know where your stop is on the rest. You just turn around and raise your stop loss up to a very deeply in the money underneath that little fake out 15-minute bars low, and you've got a free ride that you just have no idea how far that thing could go. It's a beautiful thing. All right, let's talk about liquidity. So if we're saying liquid or liquidity or a liquid market, it simply means that there are many banks that are active at that time and that they can handle size, which is big blocks of currency going off, like banker terms, 20. I want 20. That means 20 million, okay? And that's 200 standards to get 20 million. That's a lot of money. A yard is never usually hit in one fell swoop. It can take hours for a bank trader to collect a yard, or 1.5 yards of currency. That's $1 billion or $1.5 billion if you're trying to do 1.5 yards. And that takes some serious time for somebody to put that kind of size on. Now, if 1 or more yards is ever hit by accident, it is called a fat finger event. I don't know if you've ever heard that term or not in the market, but it does get slewn around often, that there's a fat finger event, and you will see something move considerably and very, very fast when that occurs. I mean, something could, quite honestly, drop 90 pips and reverse 90 pips all inside of 2 minutes. So traders that do that to their hedge funds are often fired, by the way, or sent home for a week to drown their sorrows in a bottle. And they do, because it costs a fortune. Doldrums, or off-market time, it's usually lunchtime in New York City. That's Eastern Standard Time, New York City time. It's from 12 noon to 2 p.m. when the big boys, and by the way, these New York specialists, they're big, all right, and they are also big. I mean that 2 ways. They trade like monsters, okay, and they're usually a couple 100 pounds. They go on 2-hour liquid lunches. They go to restaurants that cost $100 a plate, and their rookies are told to handle all the orders and not to do anything foolish until they get back. Now, the rookies will have power to handle small trades and do small things, but they can't do anything stupid, and they can't collect too much size for the specialist's trading account. All right. Now, off market is after 5 p.m. Eastern, and this is called the rollover time. At this time, the spreads usually go insane for about 1 or 2 minutes. The spread will go completely nutty. And swap is calculated, everything is closed, and you do not ever want to trade. Trust me, do not trade at this time. Nothing is real. You don't want to trade until Asia open. 7 o'clock or 8 o'clock Asia open is when the Tokyo exchange is opened up. It's not Wellington, New Zealand. They handle nothing. You do not want to trade at this time. Just take my word for it. I can't even possibly stress that enough. All right, leverage, FIFO, and hedging. We will talk about these 3 terms. Now, leverage is the amount of money, margin money, required to hold a position. So in the USA, pardon me, it can be horrible because they make us deal with 50 to 1. The average that is offered by most reputable brokers will be 200 to 1 or 400 to 1. And actually, you know, I got to say that, you know, a broker that offers 200 to 1 and won't give you 400 to 1, it's not to say that they're a bad broker. They're just being pretty careful. You know, they just took a look at their back office and said, you know, we'd just rather be safe than sorry. And, you know, it doesn't mean that they're bad, okay? So they're acceptable, and probably more acceptable than the ones that offer 500, 600, and 1,000. There was one company out there that, yeah, don't even do that, by the way. I can't remember the name of the company at this current time, but there's one out there. Gosh, I wish I could remember the name. Where were they? Singapore or something like that. They offer 1,000 to 1. That is insanity. To not do business with anybody offering 1,000 to 1. That is crazy. And by the way, guys, never use this leverage. It doesn't matter that they offer you 200 or 500 to 1. You don't want to use this kind of leverage. You never want to get piled up into something where, you know, you're over leveraged and you're starting to get scared. That is a no-no. Okay? Trust me. Trade big or go home is not what we're about. All right? Just don't do that. FIFO is first trade in and the first trade out. First in, first out. And it is a very horrible and restrictive rule. It's just pure evil, and only in America. Land of the free and home of the slave. I'm sorry, but we've got Frank and Dodd to thank for that one. Hedging is to go long and short at the same time or at different times in one currency pair. It's rare to do, but it does have its purposes, and you do need some advanced skill required. And we are at beginner stage right now, so I'm not going to teach you about this now, but in a future video we will talk about when to leverage ourselves up by hedging, how to do it, how much size, and exactly when to put it on, when to take it off, and how to think. I mean, there's no problem with it, really. I have none. But it does take a good hour to explain when, why, and how. So we just can't do that right now. But that'll come at a later video. And over-leveraged simply means that you have placed too much size on for your account. Okay? You've gone way too big. Your equity, you just can't handle it. If you've got an account with $1,500 in it, you decide to trade in full-size standard lots, you are way over-leveraged. This is completely unwise. It'll kill you very fast. You do not want to do that thing. Support and resistance is a place clearly seen on charts where prices want to go no lower. We're talking about support right now. Prices come down to support, and they bounce around it, and they just don't want to go through. It's very often and usually a prior resistance level where someone broke out a skill saw, okay, I just want you to think about it this way, and drilled a hole from the basement into the first floor. Then they throw the ball up into the first floor. They throw it up very hard so that it can even hit the ceiling, okay? But when it comes down, it hits the floor and it bounces. Rarely is it going to go straight back through the hole that you just cut. That's not normal, and it doesn't happen often. I mean, I'm not to say that it can't happen, but it's very rare. Now, resistance is a place where prices tend to want to go no higher. Okay, pull downs will occur from places of resistance. Now, sometimes this is an area that was once a first floor. Prices hit the floor multiple times until somebody breaks out a skill saw and decides to cut a hole in the floor, drop a ball, or throw it down into the basement, and it absolutely tanks. It hits that floor, bounces up to the breakdown spot, and just gives it a little kiss. Okay, we can call that kissing or hooking up to hook back and touch the ceiling, and then it will drop again. I hope I made a good pictorial image for you. We'll actually draw this out on a chart in our live trade room. You're going to get to see this many, many times. Dozens of times, okay? Consolidation. Run or running. Consolidation is when, usually after a run or after a good healthy move, after a trend, we can see many candles in a very tight range as the prices consolidate the gains or the losses from a very busy or active day. Or, shall I say, an active session. So this is often seen in a tight, long-lasting base of very small pip movements for many, many bars. It might even be 5 hours long. It might be 8 hours long. A 15-minute bar is just completely going sideways, and they will form like a channel, maybe just 10, 15, 20 pips from the high to the low, and it just goes sideways. Right? A run or running is when a currency is in play, which means it's breaking out or breaking down, and running or trending in one direction. That's when you're getting a run, or a currency is in play, or a currency is running. It's just one-way move. Beautiful, too. Beautiful. Usually a 45-degree slope is the best way. And pullbacks are very short-lived. It may come up and kiss once in a while. Like if you're in a breakdown, it may come up and kiss once in a while the moving averages or the river, and then fall. To scalp, or to do an intraday swing, or a swing, or booking, or washing. These are all terms you're going to need to know. Scalps are basically done on just a 1-minute chart with a 5-minute chart, and maybe you might even have one more, like a 15. And you'll be looking at the theme of the 15-minute chart in your vision, and you're saying, okay, the 15-minute is doing this. I can see it's running in a channel. Every time it breaks out, it goes this high, and every time it pulls back, it comes down and kisses and hooks into the river, the 20-period moving average. It touches it and bounces right off of it again. And you're watching this happen, right? So you're scalping on a 1-minute or a 5-minute chart. You're looking to just take it quick. It's a quick thing. You're in. Bam, there's a 1-minute buy. I'm in. And you're just looking for a fast 4 to 12 pips, maybe, somewhere in that range. You know, I have to admit, I hate booking a trade for 3 or 4 pips. It just bothers me. You know, I really don't like doing that. When I have to take a trade off for just 3 or 4, I'm aggravated. I don't want to get in there for just 3 or 4 pips. All right, I like my favorite is at least 7 or 8, and preferably all the way up to like 12 or maybe even 15 pips. I enjoy scalps that have that kind of money in them. Okay. Now, intraday swings are, let's say, 15-minute charts to 60-minute charts, and it's meant for at least a 15-pip minimum. I mean, that's got to be bare minimum, okay? And possibly right on up into the 30, 40, 50 pips. I mean, sometimes, you know, it depends on how the day goes. You can go all the way up into 75 or 100 pip maximum intraday swings, and those are wonderful. When you capture them, they're great, and you'll get them, and you're going to be one happy trader. Now, swings are anything longer than intraday. It could be 24 hours or 48 hours or maybe a whole bunch of days. There are times we can get into a trade and we'll just ride it down for 9 days, and you know, scaling out along the way, but you know, leaving a Jesse Livermore runner. By the way, that's a term I once again don't have put in here, but I'll explain it now. A Jesse Livermore runner is a small slice of whatever trade that you have on left to go for something wild and crazy. You've booked 90% of your trade for 100 pips. The day ends, the day is over, Your swing long has just closed as a ripping daily buy signal. You'd like to leave 10% of that trade on and just see what happens, because you might get 3-4 more days up and have a real winner on the last tiny piece that you have left. Okay, so booking a trade is just that. It's booking the profit or taking the profits. And now washing is a hard concept to get at first, but I'm telling you that half the people that I taught this to loved it. They said, "Oh, this is a godsend. It's the greatest thing I ever learned in my life." I taught on this at least 7 times over the years. And the other half, the people absolutely hated it. And it just depends what kind of trader you are. You might not like the concept of washing, but I do want you to know how to do it, so I am going to teach you whether you like it or not. And if you hate the thing, you can disregard it. But, I guarantee you probably 50% of you are going to love it. Washing, and I'm going to use a long example, okay? We longed a small slice of a currency at one price, but then it fell more. Now, it hits an area of support or something. Maybe, it hit a moving average. Maybe it hit, I don't know, maybe it hit a fib, okay? And it made some kind of a buy signal there. And so we're like, okay, I'll take a second one. Now we've got 2 little pieces long, right? But yet we're magically wrong on the trade, and it keeps going down. And once it goes down long, and we keep repeating this process. Now we're into it for 3 trades, and then 4 trades, and then before you know it, we're like 5 or 6 slices. Well, all of a sudden the happy feeling is all gone, okay? And if we're not getting the subsequent bounce that we expected, we have to go into wash mode. It's simply because we need to undo this small amount of damage that's currently on. We see the small amount of damage. We're like, okay, I'm into this for 5 or 6 pieces, and we're negative. And it just keeps going, and I own the trade. I own it. I own the losses. What do I choose to do? I want out. I do not want to stay in that forever. So time is money. We don't want to get caught in some kind of a power trend and take too long to get out of it. Now, I just want to park here for a moment and just talk about this. Now, I've had some of my washes, okay, some of them. We're parking right here. Don't even read on, just hear me. Sometimes I get into washing, and there may just be, 1 or 2 washes, right? And then it just turns around and pops and rips, goes higher, and that's it. You're all done. You only had to wash 1 or 2 things. Everything else came back. It was fine. There was no real reason to panic. There was no reason to worry. Other times, you might end up having to wash something, 4 times, 6 times, something like that. But if you start getting really heavy into a currency, and you start holding it for days, and you're like, oh my gosh, I've performed 20 washes already, and I've got like 20 more to go. I'm telling you right now, you're going to be an unhappy camper. You're not going to like it, okay? So really, the reason why we wash is because we don't want something like that to occur. And the beauty of it is that, 70 or 80 and hey, even sometimes 90% of our trades just go. They just work. They work wonderful, and there's never a problem. But there's always this chance that we get caught in something, and it starts to crush us a little bit and hurt us a little bit. And when that happens, I go into wash mode. And I want that trade to exit as fast as I can make it happen. And I just want you to understand that. We're going to go into much more detail on this at a later time. Now, let's say that when we buy this another time, right, we find another, let's say it broke the 50% fib, came all the way down and hit the 786 fib, and it hit a 200 period moving average, and it made the most picture perfect, beautiful 15-minute buy signal. I am going to go all in there, okay? 0.04, bam, I'm in for a whole nother piece. I will double it up. Now, when that rise, believe me, my focus is on when that happens. When we get that rise, and it comes on up, and it starts to stall, and I book those profits, maybe it's 15 pips, or maybe it's only 20, I don't know, 22 pips. I'm just using an example from recent memory. If I grab 22 pips on a 0.04, I'm going to grab all that money, I'm going to reach in and try and wash off a complete micro lot of loss. Now, it may not make sense to you right now, but as time goes by, all right, hopefully you'll understand it. If you've got half lots on or quarter lots on and you're seeing good money, I mean, I'm talking 50 bucks here, 75 bucks there, $90 here, there ain't nothing wrong with taking $72.87 and booking it and then reaching into another trade that you have and wiping away 10 bucks worth of loss. You want to wash your way out of something that's dirty, okay? And so anyway, I hope that makes sense. So what we do is we're looking to book the good money on one, lose small money on another, reduce our size of our open trade down, lower, and then just get less washes to do. That's basically it. It's an ultra valuable skill to learn, and I did develop this over years. I've done this with millions of dollars. All right, I would book hundreds and hundreds of dollars of gains, wash out for small losses, 30 bucks here, 40 bucks there, $60 here, whatever. I would repeat this dozens of times to get my positions that were totally duds to become actually quite profitable at the end of a couple of days. It wasn't a heck of a lot of fun, but I'm telling you, it is ultra valuable. It is an excellent skill to learn if you can handle learning it, and you have no idea how great it feels to look at one of your trades and you see one of them and you're down $1,000. Okay, now I'm talking when we're to much bigger account sizes than where we're starting right now. You got 50 grand in your account, you made a couple $1,000 or something, and you've got one trade that's down 1,000, and you work on it and work on it like mad, and when the trade is over at the end of a couple of days, you took that $1,000 loss and you turned it into a $1,000 gain. You will be very happy to know this skill. And I was taught by a master at it. I'm telling you, he was really good. All right, so I think am I at the end here? This might be. All right, so yep, I guess it is. All right, that's the end of what we have right now because it's not going any further. So it must be the end. Okay, guys, I hope that this has helped you. I tried really hard to think of every, every concept or every word that I could, but, it's possible I've missed a few. All right, so as the days go by and the weeks go by as we're trading together, if I ever say something and you don't understand it, just ask me to explain it, no problem. Every question is a good question. I have no problem with that. So you go right ahead and ask all the trading questions that you want as the days and the weeks and the months roll by. All right, everybody have a great day. Until next time, Robin Hood signing off for now.